Welcome to the DJE podcast, where you will learn about real estate investing from real-life examples. Here's your host, Devin Elder.
Hey guys, welcome to another episode of the podcast. Today, I'm really glad to have a special guest on. Jake Clopton is the president and founder of Clopton Capital out of Chicago, and we're going to dive in on some commercial lending is kind of be the focus of today. Without any further ado, Jake, welcome to the podcast.
Appreciate that, Devin.
Yeah, thanks for coming on. Maybe you could just kind of kick it off here with a little bit of background. And I know you've been in, had your company for a number of years, but what's kind of your background, education, and what led you to commercial finance?
Sure, absolutely. So before I started this company, actually traded like interbank hedging product futures. So most commercial loans are based off of LIBOR rates. And we traded futures that were derivatives of 3-month LIBOR. So that's kind of where I get my banking background from, which gave me a good transition into commercial banking around the 2009, 2010 area. And we originally got involved in this area because similar to what happened in the residential market, there was a lot of commercial loans that were going to be coming due and kind of have problems refinancing. And we were looking to get involved in the transaction cost area of refinancing the wave of commercial lending. So that's kind of where it started back in 2010, and then it's kind of turned into a full-blown mortgage banking firm. So today, we're a nationwide firm doing perm mortgages, bridge, construction, and then higher cap stack products like mezz, pref, and joint venture equity for real estate nationwide.
Yeah, that's great. So really the whole stack on the commercial side.
Yep.
Very good. So we're if somebody's listening to this podcast, they're likely, interested in the multifamily investment space. I mean, our firm does multifamily syndications, or maybe they're another operator looking to to fill a piece of the puzzle on the capital stack, right? Maybe we could talk a little bit around kind of specifically what you're seeing right now with multifamily financing in kind of the B and C space. I mean, you're nationwide, so you're seeing a lot of stuff. There might be maybe another sponsor here that's looking to take down a $10 million property. What are kind of some of the things, and what's your take on the kind of current temperature of the lending climate for the value add multifamily space?
Yeah, I mean, as far as value add goes, especially in B and C properties, I think there's readily available capital in various forms. And for really any geography, as long as the market's supporting it and there's a clear value add plan and exit. And it really, I think ultimately it's going to come down to as far as sizing, what that exit's going to be, and most people are sizing to either a Fannie small or Freddie small exit on the back end from the value creation. So I think that's where you're going to get the majority of your sizing from.
Yep. No, that makes sense. Are you seeing a lot of trends these days towards a certain product type? Maybe it's a bridge and then rolling over in 18 months into a Freddie or Fannie, or is it kind of all over the map at this kind of stage in the cycle?
The vast majority of what we see is private bridge. That's handling the short-term value creation, either that's the light or heavy rehab, bridging that to a Fannie or Freddie exit. And not necessarily, it doesn't necessarily have to be a Fannie or Freddie exit. That's just what they're sizing to.
Right.
So, and it really doesn't matter what loan size, anywhere from 1 up to 15 million. I think there's readily available capital for pretty much anywhere in that space.
Yep. That makes sense. How are you seeing operators right now that you're working with basically position themselves for success? I mean, getting into bridge debt, some investors have concern with where we are in the market cycle, and that we've been kind of in expansion mode for a long time now, and that we're due for some sort of a correction. But, seeing as you're seeing a lot of bridge product, what are you seeing operators do to be successful to kind of tee up, a successful bridge entry and exit?
I would say the greatest success plan is having realistic pro forma expectations based on current rents and not pro forma rents, right? I
Right.
mean, I do see some deals that come in the door here, and guys are projecting their pro forma based on where rents are even going to be 18 months from now, which I think is a little possibly a little unrealistic a lot of times. So we really want to make sure that operators are coming in, basing their pro formas based on in-place current rents. And even on the exit, even if the market, let's say we're in a top market for Fannie or Freddie, right, and they're going to underwrite to like an 80% loan to value exit, we're really going to size the loan to, a 75% of stabilized value or somewhere in there to even give a little bit of wiggle room on the exit. The other area where I've seen, some operators kind of either run in trouble or get a lot of success is, the renovation budgets and having solid, having a solid budget bid in place from a good GC going in so that there's not those surprises right after you close where the things are costing a lot more than they thought, or there's, things that they need to get done that are coming out afterwards that weren't flushed out up front. So ultimately, right, having realistic rent comp expectations and then really having a good handle on how much it's going to cost to do the value add are really the two biggest areas.
Yeah, that makes a lot of sense. Let's kind of shift gears a little bit. Bridge is popular, obviously. If the property is not stabilized or you've got sub 90% occupancy, you may have no choice but to go to a bridge product. What are some of the other? Are you seeing much else in the way of a mezz layer or anything like that on these multifamily value adds, or is it a pretty straightforward debt plus investor equity play on most of them?
I do. I think it depends on what size project you're dealing with, right? I mean, to really fit in a mezz piece into a project, it's got to be of the right size. Because let's call it, a mezz loan would need to be somewhere around a minimum of $1 million, somewhere in there. So to really fit that mezz piece in between, let's call it the 75 to 80% slice of the loan to cost of the project, it's got to be a decent size to fit $1 million into there. And that's typically what I'm seeing as like the minimum amount of mezz that mezz lenders will put out. Now, you may be able to find a capital source that will do like a stretch senior type deal, right? So you can maybe find a lender that will do a stretch senior that will do a smaller project, all as in one loan. But if you're relying on an outside mezz source, I think you're going to need to find somewhere around like, let's say an all-in total cost of 10 million plus to make that work. There's certainly, capital out there that'll do that, especially for multifamily. A lot of that's going to depend on how much upside and how much value creation you are doing, and what your going in cap rate and exit cap rates are going to be. If you're going into a tight deal and you're maybe doing just light value add, might be a stretch to really be able to build in mezz. But if you're going into a deal at a good basis, it's off market, or you find a great deal, and there's some real heavy lift and a lot of value creation, I think a piece of mezz would fit in well.
Yeah, no, that makes sense. I appreciate that. I want to talk a little bit about what you guys are doing kind of further up the stack. Obviously, Clopton Capital can source debt here, nationwide, depending on the project, and there's a lot of variables there. But talk to me a little bit about what you guys are doing with the JV piece more on the equity side, and what does that look like for you, specific to multifamily?
Right. So good question. So as far as joint venture goes, realistically, what guys are looking for, the joint venture capital partners are looking for is a good operator that they can get on board with and scale, right? They're not necessarily looking for a one-off type deal or one-off type relationship. They're looking for guys that have 3-4 projects of similar size to what they're presenting today under their belt. They want to make sure that their expectations and their underwriting going in is kind of how the deal turned out on the exit side. And then what they're looking for is a real pipeline to the future where, you get the heavy lift of the first deal out of the way, and then you can look to the next deal after that. They're not looking really just to put out, let's call it $5 million of equity just for one relationship. They want to scale, put out 50, 100 million through this relationship. I think that the most difficult part of JVs is really getting to know each other and getting that, relationship and the first operating agreements and, the structure out of the way up front. And then everything past that is a little simpler.
Yeah, no, that makes a lot of sense. The legal, it's going to be different, and it's the first time putting it together for that JV. How do you like to approach? Let's say you've got a new operator approaching. Maybe there's an operator listening to this podcast going, "Hey, we've done 4 or 5 deals of a similar size in a the same market, and we're looking to scale our business." And rather than have the 50K equity cup of coffee, 1,000 more times, have that conversation. Maybe they're looking to ramp up equity. What does that conversation look like with you? And how did they kick that process off?
Right. So actually, a lot of the guys have come to us wanting to go into this institutional JV space are really wanting to make the transition from having, like small investors that are getting involved in deals at 50,000, 100,000 at a pop and raising that type of equity and moving over to a more, reliable kind of like, one source shop for their equity. A lot of the conversation, when I am taking guys through that transition is, understanding the difference between dealing with those two different equity sources. When you're out here and you're raising equity from friends, family, or mom and pop investors, you have a little bit more ability to kind of dictate the terms and the structure to them, right? Because you think about it, every person you're bringing in is commanding maybe 50,000, 100,000, couple $100,000 worth of, equity power to you. So they can't command as big, a difference in the structure of the equity. When you're going to institutional source, right, you're talking about somebody that's going to come in with your entire equity slug, minus your GP. And,
Sure.
They have the ability to really command structure a lot more than a small investor will. So, I just think there's a general, the biggest difference is, knowing expectations going in to having terms more dictated to you versus, you making up the equity structure to smaller investors, if that makes sense.
Yeah, that makes a lot of sense. And obviously if scale is the goal for an operator, there's going to be some trade-offs there that you're going to have to accept in order to not have to raise a $5 million equity slug on a deal from 100 different investors, which is not common, but I mean it's not uncommon to have to do it that way,
Sure.
and that you're just going to reach some natural limits on the ability to raise that kind of equity.
Right.
But that's good.
Ultimately comes down to, right, the velocity of how fast you can move, right? I mean, if you have to
Right.
rate from 100 different people and deal with all of their reporting and make those phone calls, you're just not going to have as much time to go out there to find deals and put deals together. Versus if you have a JV partner that you've already negotiated operating agreements with, you know exactly what they like and you can keep going back to, and then you can get back to what you're good at, is that sourcing deals and put them together. That's going to let you scale a lot faster.
Yep. That makes sense. What are you seeing in terms of going back, I guess, to the Freddie and Fannie kind of requirements, and what's the temperature right now? I mean, I know asking you to look into the crystal ball is not a fair question on what, we're in early 2019 right now, but what is Clopton Capital's kind of outlook on the next 2-3 years in the commercial lending space? And again, totally unfair question, but I got to throw it out there for you.
No, that's fine. That's fine. I don't really see a huge disruption coming. I think the biggest risks are really, kind of credit spreads blowing out if there was to be some sort of like, high yield debt market disruption like there was back in 2015, where, you saw a lot of CMBS conduits kind of stop lending for a while and credit spreads blew out, stuff like that. But overall, the lenders seem to be generally well capitalized. And optimistic on the markets. I think there are certain lenders out there, types of lenders anyways, that have had to pull back. Those being depositories that are over regulated by the FDIC, and they keep getting new rules and new regulation kind of thrown at them daily, and sometimes they don't really know how to operate that, and it's very burdensome. But generally in the private capital market, I think things are very healthy and expanding. I think we've seen a huge expansion in, private lending, especially in private debt funds. that are putting out bridge loans. I mean, I think it's probably, every week I hear about some new bridge fund that's kind of coming on board and ramping up. So I think it's definitely very healthy, especially at minimum for the next 12 months, year and a half. If there's a recession or a downturn, I'm sure some people will pull back, but it seems like there's more than enough capital out there that's waiting for that to happen, to maybe step in and find opportunities that are at a good basis. So if there is one, I don't think it'll be, traumatic.
Right. Yeah. Well, that's a good outlook. Appreciate that. So you're seeing some smaller debt funds that might put together, a company that spins up and puts together maybe $100 million in equity or capital that they're going to go out and start placing and backing some sponsors on some bridge debt deals, and they're looking to kind of do a handful of deals throughout the country. Is it that type of setup?
Yeah, I've seen, a lot of smaller debt funds come on board. I also get a lot of calls recently from real estate companies that kind of have an excess of cash. And, for instance, I got a call the other day from a New York City based real estate company. They have a lot of excess of cash. They traditionally develop, and they were telling me that their development costs are too high right now. They don't really know what to do with their excess cash, so they're looking to lend it out. So I have seen a lot more kind of companies like that start to look into the lending space because, they're kind of short on alternatives.
Right. Yeah, that makes sense. Well, that's good for you, and it's good for operators like us that some new sources of capital are coming online, and it just gives us choices. That's great. So if let's say we've got an operator coming to you, hasn't previously had a relationship with Clopton Capital, but they've got a project under contract, and let's say it's a $10 million purchase of a value add deal. Walk me through that process of what it would look like for a new operator coming on board to work with you guys.
Yeah. So, I mean, typically if somebody new comes to us, obviously there's a little bit of getting to know you, but, we'll typically take it in. And then what we're really looking for are the usual documents, right? Budget, pro forma, background on the operator, lease comps, just general items that we're looking for on any deal. Past that, it takes us a couple days to go out there and talk to our capital partners and get terms, bring them back. We can kind of go over those terms, figure out which ones are the best fit, and then move forward from there.
Got it. Yeah, that makes sense. What have you seen really stand out for some of your borrowers in terms of putting together, their bio, and what are some, I guess, pointers for operators that you might have on putting together a bio package? Because the pro forma is going to be what it is, the renovation budget is going to be what it is, but the lender or the ultimate bank is going to obviously be placing a lot of emphasis on looking at the sponsor. What have you seen show well, or maybe there's some pointers you could give to listeners on that package?
Right. So I think you're generally going to run into, two classes of sponsors, right? I mean, one, a sponsor that's got a long track record of deals, right, that are kind of similar, and, he's doing something today that, he's not reinventing the wheel versus what he's done in the past.
Right.
The other guys that, we do run into a lot are maybe either people not with an enormous amount of experience, or that are really stepping up to a different level of deal that they haven't done in the past, but that they've been successful with smaller deals. So for those guys, what I really try to highlight is, the importance of putting together an appropriate team of people to lean on, as well as leaning on their past success. So for somebody that's coming in and hasn't done, a deal in a particular market, or hasn't done a deal of a particular size, what I really stress is important of having the appropriate GC in place, having, the appropriate, market reports that we can lean on, and like other people that have experience that, that can kind of support the team moving forward.
Yeah, that makes a lot of sense. That's good feedback. I know you probably can't get into too much detail, but is there as far as names and exact amounts, but is there a recent multifamily deal that you kind of want to speak to, that you guys walked through, from kind of initial conversation with the sponsor to getting through to the closing table? I mean, I think that's where a lot of value is added from your firm to kind of shepherd that deal through to closing and help navigate some of the minefield. I mean, is there a specific deal in mind you could kind of give a little high level case study on?
Yeah, I can talk about one particular deal we're looking at right now, kind of in Jacksonville, Florida. Um, the deal came in, and it was actually from two sponsors, both of whom were had a great deal of experience, but didn't have experience together. Meaning they were both working for other companies in the past. One of the guys had a ton of multifamily lease up experience, but hadn't done it for himself. Right.
Right.
His partner had a ton of banking and actually receivership experience, but again, this was kind of their first foray on their own. So they both definitely knew what they were doing, but it was their first time going out on their own and putting a project together. Right. So there definitely was some scrutiny around those areas. And, even though they had great backgrounds, we still had to kind of put together a team and rely on that a little bit, for going forward. That deal, it wasn't an overly complicated deal, right? I mean, it was, light rehab, re-tenanting and, pushing rents. So there wasn't anything that, was too out of the ordinary there. Ultimately, I think that deal ended up getting done at somewhere around 80% of cost, because that's what sized up to about 75% of the stabilized exit. That deal got done non-recourse, somewhere around 350 over LIBOR.
Right. Nice. Did you guys close on that deal already?
We've got a bid out right now.
Yep. Yeah. So pretty standard stuff. And Jacksonville seems to be on a lot of people's radars right now. Is there anything?
I've seen a couple deals out of there. Yeah.
Yeah. Interesting. So maybe you could talk kind of high level again for maybe an operator coming on that's looking at, bringing on a loan broker to help go through this process versus trying to kind of handle that themselves and go through the process of the financing. Maybe you could talk about some of the pros of bringing on a loan broker to walk through that process.
Sure. Yeah, absolutely. If somebody goes to do this process on their own, and let's say they haven't been doing it for 10 years, and and they kind of want to get around additional fees or whatever, I think what they're going to find is somewhat of a black curtain, right? Because there are certain lenders that are out there that are visible, but the ones that are not really necessarily the best structure, the best rates, the best fees, stuff like that. And when you go and you call up, any lender, ultimately who you're going to talk to is a sales guy, and they're going to try to sell you on the structure, and you might wind up with, either a structure, rate, or fees that are outside the market, or you really don't have a full feel of where this deal should be. When you're dealing with a loan broker, at least if the person is knowledgeable, about what's going on in this particular property and industry, they're really going to know who to go to right away and who's the most competitive and how to structure the deal appropriately, right? I mean, I see a lot of deals get done at either rates or terms that, are not necessarily optimal just because people didn't have the right resources or didn't know about a particular loan product that was available to them. Right. I see a lot of guys that are at local banks for just stabilized multifamily properties at, high rates and full recourse, and then we'll talk to them and we'll tell them about, kind of some agency product or some life insurance company product that's, extremely much more competitive and also doesn't have a personal guarantee attached to it. And a lot of times they're surprised that those products even exist. But,
Sure.
They had gone out there on their own and just kind of talked to local banks and didn't explore anywhere past there and just wound up there.
Yeah, that's a great overview. I really appreciate you doing that too, because I talk to a lot of operators that, look, everybody's looking to cut costs all the time and maybe not balancing the value. But when I look at the hats that we wear at our firm, whether it's asset management, it's acquisitions, it's investor relations. I mean, just each of those three buckets right there are kind of an all-consuming job just to do that stuff. And so I think as an operator, you've got to look at kind of the time, the dollar per hour value on your task. If you're a sponsor, and your area of expertise, right? Are you going to be the loan expert that lives and breathes this stuff every day and has the relationships? Or are you going to go try and close the next deal and manage the rehab and manage the property management company? And so,
Exactly.
I've found a lot of value in that, and it's a lot of times it's either either a wash or better in terms of the net effect. If you can get a little bit better terms and you end up paying a broker fee, you may end up with a net positive for the whole deal, which is the point for all of us is net investor returns need to be optimized, and everything kind of follows the lead there. But yeah, that's a great point. So you guys have been in business, over a decade, have a lot of these relationships, and can, help sponsors kind of avoid some missteps or turn them on to products that they didn't even know existed, right?
Absolutely. Absolutely. And a lot of times, honestly, with some of our products, there isn't even a closing fee to worry about anyways. So.
Yeah, which is fantastic. That's great. Any other things you want to touch on, kind of knowing that we're talking about, multifamily kind of value add space, specifically anything that you think, a sponsor out there listening to this might want to know, or topics you want to touch on?
One of the questions I've been asked a lot recently is how to find good deals in this market, candidly.
Sure. Yep.
And I completely understand, right? Because, anything that's on the market, like let's say it's on LoopNet or something like that, just kind of seems like it goes off overpriced.
Yep.
I have some guys that go to auction, and a lot of times I see auction deals, trade for way overpriced because people think they're getting a good deal and they just don't. One of the best tips that was passed to me that maybe I could help pass along is, a great way to find off-market deals is kind of to call around to local property managers. Those guys seem to have a really good inside track into the properties they're managing, right? Or other things they've heard of, right? Maybe they have one of their clients that needs to dispose of an asset that, the guy hasn't even thought about putting it on the market yet. You can get quick access to that. That's just a tip I'd throw out there for people looking, to find good properties. And from the credit perspective, finding something that is off market and the better basis you go in it, the better the deal's going to be ultimately.
Yeah, that's a great point. And we're definitely seeing a little bit in San Antonio in our market, but definitely in some of the other Texas markets, Austin, Houston, Dallas, seeing prices really get pushed up to the points where you kind of scratch your head and wonder how people are even getting into deals at certain price points, right? And just the value add's kind of hard to figure.
Well, we just did a joint venture deal in San Diego where the exit cap rate was a 3 3/4. So.
Okay, well,
it can get more push than it is. Yeah.
Yeah. What kind of a time horizon was that? Was that like a 5-year hold, or?
That was a 5-year hold, right? With kind of a sale exit scenario.
Yeah.
It was a large asset, in the downtown area, but
sure,
still, it was a 3 3/4 cap size exit. So
sure, yeah, that's wild. Is there any kind of guidance, just generally, you have in the multifamily space on what you like to see for kind of exit cap rate expansion over, if you've got a prevailing market cap rate of 6 and it's a 5-year hold? I mean, is there a rule of thumb you like to see on the exit, or is it case by case?
Well, actually most deals I'm seeing right now are actually sized to a higher cap rate than I think what is general in the market today. Because I think most people on the 5-year horizon, are generally feeling that cap rates will rise slightly. But I think it depends on what market you're in and then what class of property you're in, right? I tend to think, I tend to follow where aggressive financing is prevalent and, expect cap rates to compress in those areas. So if you're looking towards, let's say, like affordable housing, for instance, you see, Fannie and Freddie out there propping up affordable housing with rate discounts. If you have a very low income property, you'll get a significant rate discount from Fannie or Freddie. So over the long run, because of, availability of lower interest rates than people are getting for other property types, that would expect those cap rates to kind of compress more than the rest of the market. But generally, I am seeing people underwriting to perform a slightly higher cap rates on an exit than they are today.
Would that be like 50 basis points or higher than that?
Somewhere between 50 to 100 basis points, depending on the market and what the asset is. Yeah.
Yeah, makes sense. I wonder if you could talk a little bit, Jake, about kind of the relationship between, cap rate is such a impactful number, right? I mean, we really try to dial in all our rent numbers and our rehab budgets, but if you're projecting an exit cap of 5 years out and you're playing with your model by 50 basis points, it just has this massive impact on valuation. So obviously, as investors, we're all kind of concerned about that number, and it's kind of the one number that has the biggest impact as a variable.
Mm-hmm.
What are your thoughts on cap rates in relation to interest rates? I've kind of seen a lot of chatter lately about some folks are more of a school that interest rate environment that's rising is going to be directly correlated cap rates rising. Other folks seem to be of the school that cap rates are really more of a measure of the desirability of the asset class. I don't know if you can kind of speak to that and what your thoughts are.
Right. Well, I think it's all tied in, right? Cap rate's really just the rate of return on the asset, right? On a cash value. And, interest rates are kind of that baseline return level where you see in the economy. So there is a consideration for, like a trade-off, right? If you're looking at an investment, like, would you rather buy treasuries or would you rather buy this piece of real estate? And there's going to be a spread difference, basically your risk premium for buying the real estate over just buying, a treasury bond, which is a risk-free rate. So there's definitely a correlation in there that I would say, generally in the market as interest rates rise, cap rates should rise as well. There's a lot more that goes into cap rates, right? For real estate assets, because you have a lot more things tying into them. But the other greatest way that interest rates are going to tie into cap rates really is going to be people's buying power, right? Mm-hmm. As interest rates rise, people will be able to afford less loan versus the properties that they're buying. The less, loan dollars they can get, the harder it's going to be to pay higher prices for properties, and those cap rates should come down, at least in the short term, before, you'd see a rent increase.
Yeah, that's great. Yeah, that's a great overview. Lots to think about there and digest. Let's want to kind of transition here and kind of wrap up, but is there anything that you want to leave as kind of parting wisdom for a multifamily sponsor out there that might be listening and looking to acquire that next project? Any kind of loan wisdom or anything timely things are happening maybe right now in the market that you want to kind of impart to a sponsor out there?
Yeah, I mean, one thing I'd say is, when you're going into a new project and let's say you're sizing it up and looking to, put in your offer or your bid for a particular project, it's definitely helpful to kind of reach out to, somebody like me or somebody else that, that can give you a good feel for, what type of financing is out there for that particular deal and help you size up your offer for it. Whether that be a value add bridge or, an acquisition loan, when you know what financing is out there and what levels you can get for this property, it's going to really go a long way to help you size your offer and give you some extra negotiating power with that seller.
Yeah, that's right. The financing is such a big component, can really pull some levers in your underwriting. When do you like folks to engage you in that process? I mean, you don't want to see every deal that anybody's even looking at, but is it kind of right before an LOI goes out, or what's been ideal for you?
Well, I'm happy to take calls and size up deals quickly that people are just preliminarily looking at. That's perfectly fine. It doesn't, right? I mean, when you've been doing it long enough, it only takes a couple minutes to really size it up and give them an idea of what the rate would be and if non-recourse is available and some other aspects. As far as actually going out there and getting a deal, I do get asked quite often for something called like a pre-approval. Which doesn't really exist, right? I can only get terms for a deal that's live and exists and is kind of locked up. The best we can do is give good guidelines and structure for kind of structuring your offer going forward. And I have had people have sellers brokers call me to see if they were at least talking about it or financing was lined up, which I'm more than happy to do. It's just more about my limited ability to put a hard bid on the table for depending on where they're at in the process.
Sure. Yeah. If something's early in the process, it's going to be hard to commit 100% to. That makes sense. But that's a great resource as sponsors are going out there looking at properties. I mean, you got to be able to plug in some reasonable numbers on, or at least a best guess on the financing piece. So on that note, what's the best way for somebody that's out there pursuing a multifamily deal to get in touch with you guys?
Either just call our main number or send a contact submission through the website, or, they can absolutely contact me directly anytime. Always around. I'm happy to talk about deals.
Got it. And what's the URL or the main website, Jake?
Cloptoncapital.com.
Gotcha. And that's Clopton. And so a little bit of a disclaimer, maybe I should have put it up front, but I've worked with Clopton Capital on several of our projects. We've been very happy, and we definitely endorse reaching out to Jake on a project if you're looking at something with commercial financing needs. So, but Jake, really glad to have you on, and thanks for sharing some knowledge. And again, you guys listening, if you've got a commercial project that you need to size up financing for, throw it in the Google machine, Clopton Capital, and reach out to Jake, and he'll get you squared away. So Jake, thanks very much for your time. Appreciate it.
Absolutely. Appreciate you, Devin.
All righty. Take care.
Take care.
Thank you for listening to the DJE podcast. For more information, please go to djetexas.com.